Despite the crazy amount of evidence out there and how widely these methods are used in an institutional setting, I don't understand why more advisors don't use these for their clients. With the uncertainty around the economy, the stock market, and the volatile geopolitical situation, a lot of people are worried that their retirement might be thrown off course. And they start to ask themselves if their income in retirement is going to be stable. I'm Stephen Neely, certified financial planner with Fortress Capital Advisors. Transitioning to retirement's a huge task that can be stressful and even overwhelming for a lot of people. In this video, I'm going to show you how to maintain a steady cash flow during retirement while staying ahead of inflation and, more importantly, not putting your retirement at risk because of a financial crisis. I'll teach you little known but highly effective methods used by some of the largest institutional investors and ultra high net worth families in the world to protect the value of their portfolios during crises so that they can maintain a steady income. When people retire, naturally they want to build a portfolio for income that supplements their Social Security. Oftentimes, what you see them do is they go out and they load up on high yielding investments that, pay maybe high dividends, or they invest in things like closed end funds or real estate, something like that. And they think, well, hey, as long as I have the income that I need, I don't have to worry about any fluctuation in the value of my underlying investments. I'm going to show you in this video why that can be a huge mistake, especially for retirees. In this chart, what I'm showing you here is the impact of negative returns. And what I want to really emphasize is how they're not all created equally. And what I mean by that is that, a negative return, and you can look at the first line there, say 10%, doesn't only require a positive return of 10% to get back to break even. And, let me look at some of these examples to kind of show you what I'm talking about. So if we start in the far left column, you got the beginning value, then you look at the return, all of these are negative. Look at the ending value after that return. And then the final column there, the fourth one, is return required to break even. Notice how the return required to break even is always higher than what the initial negative return is. And that's because of how compounding works with returns. And, a simple example will kind of illustrate that. So think about the first example there with minus 10%, right? You had $1 million, you're down 10%, that's a loss of 100,000. Now suddenly your portfolio is worth $900,000. Well, simple math is going to tell you 10% on 900,000 is $90,000, not the 100,000 that you need to get back to break even. And that's why the break even percentage return is 11.1%, not 10%. Now, most investors can handle kind of small losses there. If you're down 10 and it only takes 11 to get back to break even, not that big of a deal. But what I want to emphasize here, and the point of what we're talking about is for retirees, look at how severe it gets once you get down to these higher percentages. Notice once you go down to minus 50%, how severe it starts to get as far as the return you need to get back to break even. A 50% loss requires 100% gain to get back to where you were before, far from the 50% loss that you initially experienced. Now, why is this a problem, right? If you're a long-term investor, you can recover. And I admit, if you're pretty young, it's not that big of a deal. It's going to hurt, of course, but you've got time on your side and you will probably make those losses back up. It's a huge problem for retirees, however, and this is what I want to emphasize in our video. So number one, what I'm going to show you here on this chart is I've got a high income portfolio. What I did, I went out and I found a lot of the very popular high income producing type investments. You've got really high paying dividend stocks, covered call strategies, closed end funds, real estate, so on. And I contrast this with the S&P just to kind of show you a comparison. When you look at the red box there, what I've got highlighted is, number one, the current yield is about 10.8%. So that's a very high income stream, right? Imagine on $1 million portfolio, that's more than $100,000 a year. But the second thing that should jump out to you is that max loss. And so that portfolio was down minus 48%. That happened during COVID, but that's actually worse than what the stock market did then. And not all income investments are going to be down that severely, but the ones that pay the highest are going to tend to be down like that. And you might be thinking, hey, well, what's the difference, right? Markets bounce back within 6 months of COVID. But what I can't emphasize strongly enough is that should not be your baseline, okay? And there's two reasons for this. The first reason is the government has no ability to do what they did during COVID at this stage. You look at the federal government, they flooded our markets with massive stimulus in the form of checks to just, pay people to sit at home and do nothing. They gave businesses all kinds of loans, and oftentimes loans that they didn't even need. That can't happen again in any time in the near future. And the reason is we're already running massive deficits and we have record low unemployment, right? Imagine what's going to happen in a recession. There's no way we can just keep running up our deficits. Number two, the Federal Reserve printed trillions of dollars in new money, and they were even buying investments. They can't do that again because inflation is a real problem now that they can't get under control. So they can't go out and just keep printing more and more money. The second point I want to make is that historically markets never recovered that rapidly prior to maybe the last 25 years. Here's an interesting study that came out in 2023, and they compared all these investment strategies, and what they found was that diversified 60-40 retirement type portfolios actually would have been down about 62% at some point. And it would have taken almost 8 years to recover. The reason this is a problem for retirees who are drawing from their portfolios for income is that you're going to get into this doom loop from which you will never recover. So let's go back to the chart and think about what I'm saying here. Imagine you're down 60%, as in that severe case that I mentioned. Well, now suddenly your portfolio is worth $400,000. When the economy doesn't recover rapidly, like it did during COVID, what's going to happen is that the income from your investments is going to get cut. Dividends will get cut because companies can no longer afford to pay that high of a dividend in a different and worse economic environment. The bonds that you own are going to start to default because these companies have no ability to pay them back. And so what's going to happen is that your income on your portfolio is going to get cut. If you had $1 million and it was kicking off 10%, that's $100,000 in income. And let's say you were using all of that to live, not reinvesting it. 100,000 over 400,000 is a 25% yield, which is completely unrealistic. It's never going to happen. And even if you get back down to the 10% distribution yield that you had, 10% on 400,000 is 40 grand. Suddenly you've got a $60,000 shortfall. Well, where do you get it? Well, now you have to dig into the principal of your investments. You need 60,000. 400,000 turns into 340,000. And then the next year, 10% on 340,000 is 34,000, so on. And you see how you get into this doom loop. And, even if things are recovering slowly and steadily over that time, it's not going to be enough for you to overcome this doom loop because you've taken too much of your principal. And as a retiree, you must avoid this situation. So how do we avoid it? Well, a lot of people, they love annuities or maybe rental homes, and those can be totally fine. They come with very, very high trade-offs that, in my experience and the experience of my clients, often isn't worth it. Could be worth it for you, but having those types of assets could make a lot of sense, and that could help steady your income. But remember, even in the case of rentals, if people are unemployed, how are they going to pay their rent? And real estate guys always overhype the safety of that. Regardless, there are other paths. And so I'm going to show you what we typically do. We typically take what I call a barbell approach to your income portfolio. On the one side of the barbell, you're going to weigh it down with high yielding type investments, and those are going to fluctuate in certain environments. Now, how do you steady this portfolio out? Well, that comes on the other side of the barbell where you're going to weigh with two different specific types of investments. Number one, you're going to own some assets that have a history of performing well during a crisis. We call these safe haven assets. These things work in a way kind of like homeowners insurance does, where you pay a premium and you get a massive payoff in the event of a crisis, like if your house burns down. Number two, you're going to use rules-based risk management strategies that are going to vary when you want to take full risk and when you want to reduce risk. What you're going to find is that combining these two strategies is going to make your portfolio resilient and steady your income, and then it's going to give you the opportunity to go in and buy, beaten down income assets at a cheap price because the other side of your portfolio steadied everything. So the first one is the safe haven assets, and as I mentioned earlier, one type of safe haven asset that has, millennia of data to back it up is gold. But we pair that with something called tail risk hedging, and there are investments called tail risk funds, and that's what I mentioned. That works like portfolio insurance. So you pay a small premium, but then you've got this crash insurance. So when the markets crash, you get a massive payoff. This is from an article in Reuters after COVID, and this shows the performance of these tail risk funds. Some of them paid off multiples of 1,000%. So you can imagine you only need a tiny percentage of your portfolio in this to make up for losses elsewhere. What we do, we pair this with trend following strategies, and these are strategies that have hundreds of years of data on them. They go across 40 different countries and all kinds of different asset classes. And so I'm going to highlight a couple of studies. The first one, this shows how impactful using trend following is during a crisis. These strategies have a history of being up when the markets are down. The second study, I think, that's even more important for retirees goes back to 1925. And what they do is they compare all kinds of different retirement portfolio strategies. And the big takeaway from this is that if you use trend following techniques, you can actually enhance your safe withdrawal rate by as much as 50% per year. Which, if you think that 4% is a safe withdrawal rate, now suddenly imagine you can go up to 6% safely, and that can be thousands of extra dollars for you as a retiree. So what I want to emphasize is that you don't need to find the next big investment in Bitcoin, or you don't need to discover the next Tesla to do well. People always focus on hitting home runs, but the reality is the best way to get ahead, especially for retirees, is to avoid unforced errors. And in this case, that's avoiding large losses. You don't need to be Warren Buffett. You just need to be thoughtful, proactive, and have a good risk management plan in place. Despite the crazy amount of evidence out there and how widely these methods are used in an institutional setting, I don't understand why more advisors don't use these for their clients. Regardless, I'll get off my high horse here. The point I want to make is if you're retiring in the next 5 years or you're already retired, I suggest taking advantage of our complimentary one-on-one income session. We'll evaluate your situation. You can learn about these strategies and whether they'll work for you. Sometimes they're not suitable for everyone, but if they are, you're going to get some free guidance on how to best approach retirement income. And if it makes sense, and then if you qualify, I offer a free retirement income plan where I'll do up to 3 hours of work at no cost to you. We will chart a specific path on how you can get the retirement income that you need, and you're under no obligation to ever speak to me again. So if you think you could benefit from that, click on the link to book in your one-on-one income session. And if you have any questions, don't hesitate to reach out and I will reply personally. Thanks.